Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Anything said in this piece is an opinion only. Let's kick off. So this week you've got two big numbers coming out. You've got the CPI on Wednesday in the US, which is the consumer price index, expected to go up. And also you've got the PPI, the producer price index, that's also expected to go up. Both of them are measures of inflation. Remember, they are lagging measures of inflation, so they'll give historical numbers, not future numbers, and not live present numbers, okay? But they're likely to go up. Now, if inflation comes in stronger than expected, then you could expect a push up on the dollar. However, the overall trend of the US dollar is trending downwards. It's not trending upwards, it's trending downwards. The dollar is generally looking to be weak against the euro and against the pound cable, okay? Slightly stronger against the yen. Now the Aussie dollar and the New Zealand dollar, which have pushed up interest rates unexpectedly over the last 30 days, they've actually got a little bit stronger. But overall, the US dollar against the other majors, the Canadian, the pound, the euro, Aussie dollar, New Zealand dollar, is down. So you can expect, even if inflation comes in higher than expected, you can expect the dollar to continue its downward spiral. And the other factor regarding that is to do with the banking crisis. Now, the banking crisis means there is a run on the banks, and therefore what effectively you're saying is that the dollar is not the best currency to be involved in as far as this particular crisis is concerned. So the banking crisis is putting pressure on the US dollar also, even though the regional banks on Friday shot up. Things like PacWest went up 87%. Remember, I've been calling PacWest down, and the end of PacWest, I said last week, I do continue with that view that the regional banks in the States are effectively finished. A regional bank is a bank that's valued between 10 billion and 100 billion US dollars, or assets of that amount of money. That's considered a regional bank, and they're called regional because they used to be focused on that particular region, but they've expanded from there. So the regional banks in the US are effectively over. Now, the central governments, or the governments and the central banks in the US, are looking and developing a CBDC. CBDC is a central bank digital currency. I've spoken about this on Instagram and on TikTok, but I want to focus a bit on my YouTube channel. So a central bank digital currency would run in line with the fiat, FIAT, the hard currency of that particular regime, that particular jurisdiction, or that particular country. In this case, we're talking about the US. So in the US, you've got the US dollar, the cent, the dime, the quart, and the dollar. That is the main hard cash currency in the US. Now, in parallel or in tandem with that, the Fed is looking at bringing on board a CBDC, a central bank digital currency, to challenge, combat, and devalue cryptocurrencies and wipe out Bitcoin. Why do they want to do that? For several reasons. Overall, there is a major theory or conspiracy theory that the governments want more and more control of you as an individual. This was highlighted during the pandemic of the Chinese flu, or COVID-19, or Corona, whichever you call it, and they got more and more control through you through the vaccinations. Now, a CBDC, a central bank digital currency, effectively will know all about your spending habits and your shopping habits and your general financial management habits. It's not like a Bitcoin or crypto where it's more or less hidden. Here it is clearly transparent, and therefore that'll give more control to the central governments and to the Fed to understand what you're doing, effectively turning into more powerful police state. So there's a slow deterioration of the freedom of the individual in the Western world. That freedom has been eroded already for the last few years. The Democrats want to erode it even more, and they do that by challenging your control of your money, including in terms of interest rates, in terms of medical care, and in terms of overall conduct. So the CBDC is a bad thing. It's a bad idea. It's a bad asset class not to get involved in CBDCs, because the more you get involved with the CBDC, it's the more you're handing over control of your life and your money management to the central government. Now, the central governments are effectively bankrupt. Okay, the central banks the central banks are government. The central banks are bankrupt and the governments are bankrupt. And begin to talk like Kamala Harris and Joe Biden. So the governments are bankrupt and the central banks are bankrupt. The central banks have an unlimited printing machine. They can print money whatever they want at any time they want. The local banks don't have that facility. So the local banks, it'll be totally answerable to the Fed. And as long as the Fed's got its control over the printing button, then the local banks and the regional banks and the major top tier banks will have to answer to the Fed or the central banks. And the CBDC will put more control into the hands of the Fed. Going forward, one way to combat that is simply don't use a CBDC, use hard currency, use regular bank transfers, and use Bitcoin and cryptos. And that's one of the reasons why the crypto sector, the crypto as an asset class, might grow, because it's there to combat control by the central banks and the governments. So you could see Bitcoin rising up just on that premise alone. In addition to that, there'd be a flight to gold as the recession tightens, as the recession bites into the everyday life of the individual. You'll see a flight to safety. That flight to safety will be things like gold or US treasuries. Gold at the moment on Friday came off dramatically after the stronger than expected non-farm payrolls, but the gold as an asset class is likely to move back up to 2040-50 to 2100, 2200, especially if we go into recession, and especially if we go into cataclysmic market crash that we could see along the lines of 1929, which was the worst stock market crash in history, and we could surpass that. At the moment, the banks that have failed, the $680 billion in value of banks that failed is greater than the 2008 crash of the banking crisis, where Lehman's, Bear Stearns and all the other 400 smaller banks completely crashed. This is Mayor Valensky with Driving Markets. You can share, subscribe, comment. Catch you later.